Hey everyone, welcome back to the channel. Today we're going to discuss investing in China, and we're going to use Alibaba as our example, as they are probably one of the, if not the largest company from China that foreign investors invest in. So there's been a lot of negative sentiment recently, and I'm going to try and peel back a layer of the complexity to hopefully help you make a more informed decision on if you should or should not invest in China. For starters, there's three main ways to invest in China. The first is to invest directly in China through the Shanghai Stock Exchange or the Shenzhen Stock Exchange. As a foreign investor, there's some restrictions and requirements that need to be met to actually be able to trade on these markets. The easiest way as a retail investor to invest directly in China is through a program China has called the Stock Connect program, which is a program set up to allow access to Chinese stocks through your foreign broker-dealer. But even this has its limitations and appears to be mostly geared towards institutional and qualified investors. This route isn't one most US investors will take, and the big names like Alibaba, JD, Tencent, Neo, and others that have a lot of US investors are not even traded on the Shanghai or Shenzhen stock exchanges. It'll be mostly industrial conglomerates and financial institutions that kind of reign king on these exchanges and actually have significant rules in place to limit or exclude foreign investors altogether. However, an investment made in this fashion would be the same as investing in a company in the US. You would be purchasing shares in the underlying business and own an equity stake. The second way is to purchase shares on the Hong Kong Stock Exchange. The options may be limited, and the ones you probably want to buy will actually also be available on a US-based exchange, such as Tencent or Alibaba. This leaves us the third option, which is to purchase an ADR of a Chinese company that is listed on a US exchange. An ADR is an American depository receipt, and it is when a foreign company takes a handful or all of their shares and lists them on a US exchange with similar requirements as a US-based company. Now, what we've seen so far is that for direct investments in China through the Shanghai or Shenzhen Stock Exchange, there's a lot of restrictions and requirements. So how does buying an ADR on a US exchange bypass those requirements? This is where the variable interest equity or VIE structure comes into play. There's a lot of confusion around this. So let me first clear one thing up, and then we will discuss details of this structure and what it actually means for US investors. There's a fair amount of discourse stating that buying on the Hong Kong exchange is better than buying an ADR on the US exchange. This is false. I see this all the time with BABA. Individuals will go online and say buy BABA directly on the Hong Kong exchange under the ticker 9988 instead of on the New York exchange under the ticker BABA. There is no difference in the underlying security that you are owning or purchasing. In either case, you're purchasing an equity stake in a company based out of the Cayman Islands that has signed a contract with Alibaba. If we look at their 20F, we can clearly see on the first page, they're traded under both 9988 on the Hong Kong exchange and BABA on the New York Stock Exchange. You're not buying direct equity in BABA by purchasing on the Hong Kong exchange. Now this leaves us to the next question, what is a VIE? There's a great interview online with Marcia Ellis, who's a leading private equity lawyer in Hong Kong, and she breaks down the VIE structure very well. I'll link the interview and article below, so feel free to check those out. But the breakdown of a VIE is this. Foreign investors invest in a company that's usually going to be based out of the Cayman Islands. This company has a subsidiary based in China that's wholly owned by the foreign enterprise, so the company in the Cayman Islands. This subsidiary will enter into contractual agreements with the actual company you want to invest in. For our purposes, we'll use Alibaba. So this wholly owned enterprise will sign contracts with Alibaba, stipulating that Alibaba pays over any profits to this subsidiary as a consulting fee or similar fee. There will then be an additional set of control contracts that will give certain controls to the wholly owned entity over the actual firm. In our example, Alibaba. What this means is the original founders of Alibaba created a shell company in the Cayman Islands that they own 100% of. They then created a subsidiary in China that is 100% owned by the Cayman Islands firm that will then enter into agreements with Alibaba to turn over 100% of the profits of Alibaba to the subsidiary in China and then pass those profits onto the firm in the Cayman Islands. At this point, the Alibaba founders would own 100% of the Cayman Islands company, the subsidiary in China, and the actual domestic firm Alibaba. What happens next is the Alibaba owners decide to list preferred shares of their Cayman Island company to be sold to foreign investors, usually both on the Hong Kong exchange and as an ADR on a US exchange. These preferred shares will almost always have no voting rights, but will entitle foreign investors to the profits of the contracted firm, so Alibaba in our example. Now, a common thing people confuse here is they think there's a liquid market for the actual domestic firm like Alibaba. This is not the case. Alibaba, the domestic firm, is only traded through the VIE structure, and the domestic equity is not actually liquid at all. As a firm, you sort of pick your poison. You enter into this VIE structure to open yourself to raising capital from foreign investors, or you list directly on the Shanghai or Shenzhen exchange and limit the amount of foreign capital that can flow into your company. Here's a great diagram of the typical VIE structure for a Chinese firm from Crane Shares, who does the interview with Marcia. You can see here the boxes in orange would represent the domestic owners of Alibaba, and the green and blue would be the offshore Cayman Island companies and subsidiaries located in China. The dark blue in the lower left is the actual domestic firm that enters into the VIE contracts. Alibaba actually does a great job highlighting the structure for us in their annual filings. You can see the top level Cayman Islands firm and the subsidiaries below. They have a subsidiary located outside of China for each business segment. It looks like they then have the wholly owned subsidiary located in mainland China that has entered into the contracts with the underlying operating units of the domestic Alibaba business unit. Something to note is that this structure works as long as the majority owner of the Cayman Islands firm is the same as the majority owner of the underlying domestic firm. For Alibaba, this would mean whoever owns the majority of the Cayman Islands firm must also be the same owner of the domestic firm. This would actually ensure alignment of interest between the two and ensure enforcement of the VIE contracts. A quick search shows the major owners of the Cayman Islands firm are SoftBank, Joseph Tai, and Jack Ma, which is a good sign as both Joseph and Jack are co-founders of Alibaba, and SoftBank was an investor in Alibaba pre-IPO, so they all own significant portions of the domestic firm as well as the Cayman Islands firm. Another quick question to hit on before moving to the risks is to talk about why the VIE structure ever came about in China. The main reasoning is China has historically limited investments from foreign investors in industries they deemed critical to China's success. Think financial institutions and tech companies. Tech companies came up with this idea to follow in the footsteps of Enron and use the VIE structure in a unique way to circumvent direct ownership of foreign investors. A lot of early agreements also had provisions that once the legality of the VIE structure came about, then the structure would go away and be converted into equity in the actual domestic firm. The idea early on was that Chinese regulators would slowly change and they would lift these bans on foreign investments. This hasn't fully happened, but China has said they will not be cracking down on VIEs and are working on outlining plans for companies to actually go public through this structure if they meet certain requirements put in place by the Chinese Securities Regulatory Board. Now that we've covered the VIE structure, let's talk about some common risks you will encounter with it. The first one we just briefly hit on, but essentially the VIE contracts are probably unenforceable. If the leadership of the domestic firm is not aligned with the VIE, then the VIE is basically worthless. China is not going to enforce this contract, and the US doesn't have the ability or authority to force compliance either. However, if a firm goes against the VIE contract, they are essentially removing themselves from ever receiving capital from foreign investors again. The biggest way to mitigate this is doing the research on who the largest shareholders are of both the shell company in the Cayman Islands and the domestic firm located in China. If they're roughly aligned, you most likely won't run into any issues. The next big issue is you won't own the underlying business, and China is still a communist country. And even with adopting more free market-like principles, they can still at any moment seize assets, imprison executives, or shut down operations of business. We've actually seen this happen in the past when Alipay was spun out of Alibaba without compensation to the VIE holders. This is a real risk, and it's tough to find a way to mitigate it. It's something you might have to just live with as a foreign investor in China. And then probably the last large risk is the risk of delisting by the SEC. The SEC passed rules back in 2020 to allow them to delist any foreign company that does not comply with the requirements of disclosing audit information. There was a lot of problems back around 2018 or so when the Chinese government would not comply with requests for further audit information on companies. And with the fallout of Luckin Coffee, this caused the SEC to pass rules that will help protect US investors. How this would actually play out is still to be seen. Would the SEC actually delist Alibaba if they didn't provide audit information? That's hard to say. It would destroy the value of the stock and lose a lot of money for investors in the US. So while probably not a real risk for large Chinese companies, it could be very much a risk for small cap or growth companies in China. For companies like JD.com, Tencent, and Alibaba, I think the risk of the VIE structure is pretty minimal. The Chinese government has announced a lot of favorable verbiage around VIEs and even amended their draft of the Foreign Investment Act to remove all the anti-VIE provisions they had in the rough draft in the final version. The biggest risk, honestly, would be increased conflict between China and US that could potentially lead to drastic measures by China. But this would substantially impact the Chinese holders as well, as they're investing in these same VIEs as foreign investors. Anyways, I hope you found this useful and it sheds a little bit more light onto what investing in China really is and some of the risks to be considered. Leave any questions or comments below, and as always, if you haven't, please like and subscribe.